Currencies and other financial markets. What is the correlation between Forex and other financial markets? Welcome to Forex Sonic, Forex Audio Library. Today we are going to learn 8 to 10 pages from Currency Trading for Dummies by Mark Galant and Brian Dolan. So let's start. As much as we like to think of the Forex market as the be-all and end-all of the financial trading markets, it doesn't exist in a vacuum. You may even have heard of some of these other markets: gold, oil, stocks, and bonds. There's a fair amount of noise and misinformation about the supposed interrelationship between these markets and currencies or individual currency pairs. To be sure, you can always find a correlation between two different markets over some time, even if it's only zero, meaning the two markets aren't correlated at all. Remember, always keep in mind that all the various financial markets are markets in their own right and function according to their internal dynamics based on data, news, positioning, and sentiment. Will markets occasionally overlap and display varying degrees of correlation? Of course, it's always important to be aware of what's happening in other financial markets. But it's also essential to view each market from its perspective and to trade each market individually. Let's look at some of the other key financial markets and see what conclusions we can draw for currency trading. Number 1 is gold. Gold is commonly viewed as a hedge against inflation, an alternative to the US dollar, and as a store of value in times of economic or political uncertainty. Over the long term, the relationship is mostly inverse, with a weaker USD generally accompanying a higher gold price, and a stronger USD coming with a lower gold price. However, in the short run, each market has its dynamics and liquidity, which makes short-term trading relationships are generally tenuous. Remember, overall, the gold market is significantly smaller than the Forex market, so if we were gold traders, we'd sooner keep an eye on what's happening to the dollar, rather than the other way around. With that noted, extreme movements in gold prices tend to attract currency traders' attention and usually influence the dollar in a mostly inverse fashion. Second financial instrument is oil. A lot of misinformation exists on the internet about the supposed relationship between oil and the USD or other currencies, such as CAD or JPY. The idea is that, because some countries are oil producers, their currencies are positively or negatively affected by increases or decreases in the price of oil. If the country is an importer of oil, and which countries aren't today, the theory goes, its currency will be hurt or helped by higher or lower oil prices. Correlation studies show no appreciable relationships to that effect, especially in the short run, which is where most currency trading is focused. When there is a long-term relationship, it's as evidence against the USD as much as, or more than, any individual currency, whether an importer or exporter of black gold. Hey everyone! If you're enjoying our Forex Audiobooks channel, please help us out by subscribing to the Forex Sonic, liking any videos you find helpful, and sharing them with your friends or anyone else who might find them useful. We'd also love to hear your comments and feedback, so please leave a comment on any video you watch to let us know what you think. Thanks for your support. Remember, the best way to look at oil is as an inflation input and as a limiting factor in overall economic growth. The higher the price of oil, the higher inflation is likely to be and the slower an economy is likely to grow. The lower the price of oil, the lower inflationary pressures are likely, but not necessarily, to be. We like to factor changes in the price of oil into our inflation and growth expectations, and then draw conclusions about the course of the USD from them. Above all, oil is just one input among many. Number 3 is stock. Stocks are microeconomic securities, rising and falling in response to individual corporate results and prospects, while currencies are essentially macroeconomic securities, fluctuating in response to wide-ranging economic and political developments. As such, there is little intuitive reason that stock markets should be related to currencies. Long-term correlation studies bear this out, with correlation coefficients of essentially zero between the major USD pairs and US equity markets over the last 5 years. The two markets occasionally intersect, though this is usually only at the extremes and for very short periods. For example, when equity market volatility reaches extraordinary levels, say, Standard & Poor's loses 2+% in a day, the USD may experience more pressure than it otherwise would, but there's no guarantee of that. The US stock market may have dropped on an unexpected hike in US interest rates, while the USD may rally on the surprise move. Next is bonds. 1. Fixed income or bond markets have a more intuitive connection to the Forex market because they're both heavily influenced by interest rate expectations. However, short-term market dynamics of supply and demand interrupt most attempts to establish a viable link between the two markets on a short-term basis. Sometimes the Forex market reacts first and fastest depending on shifts in interest rate expectations. At other times, the bond market more accurately reflects changes in interest rate expectations, with the Forex market later playing catch-up. Tip: overall, as currency traders, you need to keep an eye on the yields of the benchmark government bonds of the major currency countries to better monitor the expectations of the interest rate market. Changes in relative interest rates, interest rate differentials, significantly influence Forex markets. That's it for today, and thank you for listening to Forex Sonic. We hope you learned a lot from today's activity. The next part of the book will be delivered in upcoming videos.